The richer you get from dividends, the less exciting your life becomes. I know a guy, real person, let's call him Marcus, 38 years old, works in logistics, makes about $75,000 a year. Back in 2016, Marcus put $100,000 inheritance from his grandfather into what Wall Street calls a dividend growth portfolio. Nothing sexy, no crypto, no options, no AI stocks that promise to 10x in 6 months, just boring companies that mail him checks. Fast forward to today, early 2026. Marcus still works the same job, drives the same car, lives in the same apartment, but here's what changed. Every single month, money appears in his account. He didn't work for it that month. He didn't sell anything. The money just shows up. In January, it's $295. Doesn't sound like much, right? But March hits and it's $312. Then April drops back to $288. The amount bounces around, but it never stops coming. And the weirdest part, Marcus told me he checks his portfolio maybe twice a year now because there's nothing to check. The system runs itself. So here's the question that should be keeping you up at night. If you put $100,000 into the right dividend stocks today, what would that actually pay you every single month? Not in some fantasy scenario, not if everything goes perfect. What's the realistic number when the checks start hitting your account? And more importantly, what would that same portfolio pay you in 10 years? 20 years? 30 years? Because here's what I'm going to walk you through in the next few minutes. I'm going to show you the exact portfolio breakdown, the specific companies, the real monthly payment schedule, and the long-term projections that most financial advisors won't show you because, frankly, it makes their 2% management fee look pretty stupid. This is not about getting rich quick. This is about building a system that pays you while you sleep and understanding exactly what that system pays month by month, year by year, until you're looking at $10,000 a month in passive income without selling a single share. Let me start with the thing nobody tells you about dividend investing. The entire strategy is built on one psychological shift that most people never make. And until you make this shift, none of the numbers I'm about to show you will make any sense. Think about how you've been taught to make money from stocks. You buy low, sell high. You watch the charts, you try to time the market. You feel smart when your stock goes up 15% in a month, and you feel like an idiot when it drops 12% the next week. Your net worth is this bouncing number that changes every time you refresh your app. It's exhausting. More importantly, it's a hamster wheel. Here's the shift. Dividend investing is not about what your stocks are worth. It's about what your stocks pay. Let me give you a metaphor I'm going to keep coming back to. Imagine you own a vending machine. You paid $5,000 for it. You put it in an office building. Every month, that machine generates $150 after expenses. Now, here's the question. Do you care what someone else would pay you for that vending machine today? If some guy offers you $4,000, do you sell? If another guy offers you $6,000, do you sell then? No. Because you're not in the business of selling vending machines. You're in the business of collecting $150 a month. The machine's market value is irrelevant as long as it keeps paying you. That's dividend investing. The companies are your vending machines. The dividends are your monthly cash flow. The stock price, that's just what someone else would pay you to take over your vending machine route. You don't care, you're not selling. This is where people's brains short circuit. Because we've been conditioned to think about stocks as pieces of paper that go up and down. But dividends reframe everything. You're not buying volatility, you're buying income streams. And once you understand that, the entire approach to picking companies changes. You stop asking, will this stock double? You start asking, will this company keep paying me? And will it pay me more over time? Now, here's where it gets interesting. Because not all dividend stocks are created equal. And the companies that look the safest are often the ones that blow up in your face. You've probably seen them. Stocks yielding 8%, 9%, sometimes 12%. And your brain does this quick math. If I put $100,000 into a stock yielding 12%, that's $12,000 a year, $1,000 a month. That sounds incredible. Here's the problem. high yields are usually a trap. When a stock's dividend yield is abnormally high, it's typically because the stock price has collapsed, and the stock price collapsed because the company is in trouble. So you're not buying a safe income stream. You're buying a ticking time bomb that's going to cut its dividend in 6 months, and then you're left with nothing. I'll give you a real example. Back in 2019, there was a company called Occidental Petroleum, oil and gas. Dividend yield shot up to something like 8%. Looked amazing on paper. Then 2020 happened. Oil prices went negative, if you remember that insanity. Occidental slashed its dividend by 86%. Everyone chasing that high yield got destroyed. So the first rule of building a dividend portfolio that doesn't implode is this. You're not looking for high yields. You're looking for safe yields that grow over time. That's the difference between a dividend yield of 3% that increases every year and a dividend yield of 9% that gets cut to zero. One makes you richer in 10 years. The other makes you poorer today. Now you might be thinking, okay, so how do I know which companies are actually safe? This is where you need to look at something called the payout ratio. This is the percentage of a company's earnings that is paying out as dividends. If a company earns $1 per share and pays out 90 cents as a dividend, that's a 90% payout ratio. That's dangerous because if earnings dip even a little bit, the dividend is gone. You want companies with payout ratios below 60%. That gives them room to keep paying you even when business slows down. It also means they're reinvesting 40% or more of their profits back into the business, which helps them grow, which eventually helps them pay you more. Here's the second thing you need to understand. Dividend investing is not about finding one perfect stock. It's about building a system where the payments show up consistently, month after month, without gaps. Most dividend stocks pay quarterly, 4 times a year. That's normal. But if all your stocks pay in the same months, you're going to have this weird situation where January pays you $600 and February pays you $0. That feels bad psychologically, even if the total is the same. So the smart move is to stagger your holdings. You want some companies that pay in January, April, July, October. Others that pay in February, May, August, November. And ideally, you have at least one holding that pays monthly to smooth out the gaps. This is where REITs come in. Real estate investment trusts. They're required by law to pay out 90% of their income, so their yields are usually higher. And a lot of them pay monthly. Adding a REIT, like Realty Income, ticker symbol O, gives you that monthly cash flow that makes the whole system feel more consistent. Now, here's the part where I show you the actual portfolio. The one that takes $100,000 and turns it into a reliable income stream that grows itself over time. This isn't theoretical. This is a real allocation that real people use. I'm going to break it into 4 categories, and I'm going to split the money evenly across 10 positions, $10,000 per position. Simple, clean, balanced. Category 1 is dividend ETFs, specifically SCHD, the Schwab US Dividend Equity ETF. This fund holds about 100 high-quality dividend stocks, and it filters for financial strength and sustainable payouts. Yield right now is about 3.75%. $10,000 into SCHD gives you instant diversification and acts as the foundation, the boring anchor that holds everything steady. Category 2 is blue chip dividend stocks. 5 positions here. Procter & Gamble, yield 3.03%. Coca-Cola, 2.9%. PepsiCo, 3.93%. Johnson & Johnson, 2.6%. And AbbVie, 3.1%. These are companies that make products people buy no matter what. Toothpaste, soda, medicine, recession-proof. They've been paying dividends for decades, and most of them raise the payout every single year. $10,000 into each of these 5 companies gives you consumer stability and healthcare durability. Category 3 is REITs. 1 position. Realty Income, yield 5.67%. This is the monthly payer. Realty Income owns commercial properties, leases them to tenants like Walgreens and FedEx, and sends you a check every single month. $10,000 here gives you high income and monthly consistency. Category 4 is growth-oriented dividend stocks. 3 positions. Air Products and Chemicals yield 3.1%. Nexstar Media Group, 3.76%. Consolidated Edison, 3.55%. These pay smaller dividends now, but they have room to grow. $10,000 into each gives you industrial strength, media exposure, and utility reliability. Add it all up. That's $100,000 spread evenly across 10 positions, 4 categories, diversified across sectors, staggered payout schedules, safe payout ratios. This is the machine. Now, here's what that machine actually pays you, month by month in year 1. January, Realty Income pays you $47. Procter & Gamble pays $76. Air Products pays $78. AbbVie pays $78. Total for January, $279. February, Realty Income, $47. Nexstar, $94. Consolidated Edison, $89. Johnson & Johnson, $65. Total, $295. March, Realty Income, $47. SCHD, $94. Coca-Cola, $73. PepsiCo, $98. Total, $312. April, same as January, $279. May, same as February, $295. June, same as March, $312. This pattern repeats. Some months pay more, some pay less, but every single month, money hits your account. The total for the entire year, $3,544. That's about $295 per month on average. Now, I know what you're thinking. That's it? $295 a month for a $100,000 investment? That's not even enough to cover rent. You're right, it's not. But here's what you're missing. This portfolio isn't built for year 1. It's built for year 30. And the magic happens when you reinvest every single dividend payment instead of spending it. This is called a DRIP, Dividend Reinvestment Plan. Every time a dividend hits your account, it automatically buys more shares of the stock that paid it. Those new shares earn their own dividends. Those dividends buy more shares. And the cycle feeds itself. In year 1, you earn $3,544 in dividends. You reinvest all of it. Your portfolio value grows to about $111,000. In year 5, your dividends are up to about $5,000 for the year. Portfolio value around $158,000. By year 10, you're earning roughly $10,000 a year in dividends. That's $830 a month. Your portfolio is worth about $288,000. You haven't added a single new dollar. You just reinvested the payments. Now you're asking yourself, okay, that's better, but I still can't retire on $800 a month. Fair, keep going. By year 20, your dividends hit about $35,000 a year. That's close to $3,000 a month. Portfolio value, $870,000. At this point, that dividend income could cover your mortgage, your car payment, your insurance. You're not financially independent yet, but you're significantly less dependent on your paycheck. By year 30, and this is where it gets absurd, your dividends are $124,000 a year. That's over $10,000 per month. And your portfolio is worth about $2.76 million. Let me say that again. You started with $100,000. You didn't add another dime. You just reinvested the dividends. And 30 years later, you're collecting 10 grand a month in passive income from a portfolio worth nearly $3 million. That's the power of compounding that nobody wants to talk about because it requires patience, and patience doesn't sell courses. Now, here's the kicker. Most people will never do this. Not because it's hard, it's actually stupidly simple. They won't do it because it's boring. There's no thrill, no 10-bagger moonshot, no story to tell at a party. You're just collecting checks from companies that make soap and soda. It's the financial equivalent of watching paint dry. But that's exactly why it works. The boringness is a feature, not a bug. Because boring means you're not tempted to trade in and out. Boring means you're not checking your phone every hour. Boring means the system runs itself while you live your life. I want to show you what this looks like in practice with a real scenario. Let's say you're 35 years old. You manage to scrape together $100,000. Maybe it's savings, maybe it's an inheritance, doesn't matter. You put it into this exact portfolio. You set up automatic dividend reinvestment, and then you forget about it. You keep working. You keep living. You don't add new money because life is expensive and you've got other priorities, but the portfolio just sits there, compounding in the background. At 45, you check in. Your portfolio is worth $288,000. It's paying you $10,000 a year. You think, that's nice, but you don't need the money yet, so you keep reinvesting. At 55, you check again, $870,000, $35,000 a year in dividends. You start thinking about early retirement. You realize that if you can cover $35,000 a year from dividends, you only need your job to cover the difference between that and your lifestyle. Maybe you go part-time. Maybe you take a lower stress job. At 65, you're done. Portfolio is worth $2.76 million. It's paying you $124,000 a year. You never have to work again. You never have to sell a single share. You just collect the checks. That's what $100,000 in dividends actually does. It doesn't make you rich next year. It makes you free in 30 years. But now you might be thinking, okay, this sounds great, but what if I screw it up? What are the ways this falls apart? Let me give you the 3 biggest mistakes people make with dividend portfolios. Because if you avoid these, you're already ahead of 90% of people who try this. Mistake number 1, chasing high yields. I already touched on this, but it's worth repeating because it's the most common way people destroy their portfolios. You see a stock yielding 10% and you think you're getting a deal. You're not. You're buying a company that's probably about to cut its dividend. Stick to yields between 2 and 6% from companies with strong balance sheets. Boring wins. Mistake number 2, not diversifying across payout months. If all your stocks pay in March, June, September, and December, you're going to have 3 months of zero income between each payout. That feels terrible. It makes you question the system. You want to smooth the income across the year, so you're getting paid every single month. That's why you include monthly payers like realty income and you stagger your quarterly payers. Mistake number 3, taking the dividends as cash too early. This is the most tempting mistake. You see $295 hit your account in month 1 and you think, I'll just spend this. It's not that much. But that $295, if reinvested, turns into thousands of dollars in year 20. Every dollar you pull out is a dollar that can't compound. If you need the income now, fine. But if you don't, reinvest every penny. That's where the magic happens. Here's the uncomfortable truth about dividend investing that nobody wants to say out loud. It is a rich person strategy that works best if you're already rich. If you're living paycheck to paycheck, $100,000 feels like a fantasy. And even if you somehow got $100,000, you probably can't afford to lock it up for 30 years without touching it. You need that money now. But if you're in your 30s or 40s, you've got some savings, you're earning decent money, and you're looking for a way to build wealth that doesn't require you to become a day trader or a real estate mogul, this is the simplest path. The system doesn't care about your intelligence. It doesn't care about your network. It doesn't care if you went to the right school. You buy the stocks, you reinvest the dividends, you wait. That's it. And the longer you wait, the more absurd the results become. Because compounding is the only force in finance that actually feels like magic. It's slow at first, painfully slow, but once it catches momentum, it's unstoppable. There's a reason Warren Buffett, the richest investor in history, made 99% of his wealth after the age of 50. It's not because he got smarter. It's because compounding takes time. The first decade builds the base. The second decade builds the momentum. The third decade builds the fortune. So here's my final take. If you're serious about building wealth and you don't want to spend your life glued to a screen watching charts, dividend investing is the most boring, most reliable, most underrated strategy available. You're not going to get rich in a year, You're not going to have a viral success story. You're not going to impress anyone at a cocktail party. But in 20 years, when your friends are still grinding at jobs they hate, you're going to be collecting 5 figures a month in passive income from companies that make toothpaste and rent out strip malls. And that's the trade-off. Excitement now or freedom later. Most people pick excitement. And most people stay broke. The 3 practical takeaways are this. 1. Build your portfolio around dividend sustainability, not dividend size. Payout ratios below 60%. Companies with 10+ years of dividend history. Diversification across sectors. Boring always wins. 2. Stagger your payout schedule so you're getting paid every month. Include at least one monthly payer like a REIT to smooth out the cash flow and make the system feel consistent. 3. Reinvest every dividend for at least the first 10 years. Don't touch the money. Let compounding do the heavy lifting. The income you give up now becomes the fortune you collect later. And here's the cynical line to close on. The financial industry doesn't want you to know how simple this is. Because if you knew you could build a $3 million portfolio by buying 10 stocks and reinvesting dividends for 30 years, you wouldn't need their 2% management fee, their actively managed funds, or their expensive advisors. You just need patience. And patience doesn't pay their bills.